how to get rid of private mortgage insurance. If you bought your home with less than 20% down, you probably had to add private mortgage insurance to your conventional loan. PMI can get you into your dream home, but it can also add hundreds of dollars to your monthly payment. The good news is that depending upon the type of private mortgage insurance that you got, you may not need to pay it forever. And I'm going to share with you exactly how. We're going to go over the basics of PMI, what it covers, and we'll also show you how and when you can stop paying it. So what is PMI? Your lender requires PMI payments when you buy a home with a mortgage and bring less than 20% for a down payment. But what exactly is PMI and what protection does it afford you? PMI is a type of insurance that protects your lender in the event that you default on your loan or go into foreclosure. PMI does not protect you as the homeowner, but you still have to pay the monthly insurance expenses for your lender. PMI is often confused with two other types of mortgage insurance. Homeowners insurance. Homeowners insurance protects you against damage to your property. Most lenders require that you have some form of homeowners insurance as a condition of your loan. The next is mortgage protection insurance. Mortgage protection insurance is a type of optional coverage that pays off your mortgage in the event that you die before you own your home. This is also sometimes referred to as mortgage life insurance. It's important to know the difference between PMI and other types of insurance. As the buyer, the only benefit you get from PMI is the ability to buy a home without waiting until you have the money for a 20% down payment. There are two different types of PMI for conventional loans: borrower-paid mortgage insurance, that would be BPMI, and lender-paid mortgage insurance, LPMI. BPMI is the most straightforward, simple type of PMI. Your lender adds a PMI fee onto your monthly statement with BPMI. You must continue to pay these BPMI fees until you reach 20% equity on your home. Once this threshold is reached, you can request cancellation. LPMI allows you to avoid adding a fee to your monthly payment. Instead, you accept a slightly higher interest rate than you could get without PMI. It's important to remember that unlike BPMI, you cannot cancel LPMI. LPMI sticks around for the life of the loan, and you'll need to continue paying the same interest rate after you reach 20% equity. Choosing LPMI means you may have the option to pay all or some of your PMI costs at closing. You'll get a lower interest rate if you make a partial payment towards your PMI. If you pay the entirety of your LPMI costs at closing, you'll get an interest rate that's identical to the one you would have got if you didn't have to pay LPMI. LPMI and BPMI only apply to conventional mortgages. How much does PMI cost? The amount you pay for PMI depends on a wide range of factors, including your down payment. Your lender will charge some kind of PMI if your down payment is lower than 20%. The lower your down payment, the higher risk you are to lenders. Your credit score. This number indicates to lenders how responsible you are when you borrow money. Do you always make your payments and on time? What your credit score will be higher. Do you frequently miss payments or max out your credit? Your score is going to be lower. A lower score indicates that you may be likely to default on a loan. As a result, you pay more interest, more PMI. Your loan type, you'll pay less PMI if you have a fixed rate loan. This is because fixed rate loans are more predictable for lenders compared to adjustable rate mortgages. Your property type, debt to income ratio, and home value may also influence how much you pay for PMI. As a general rule, you can expect to pay 0.5% to 1% of your total loan amount per year in PMI. PMI helps your lender avoid financial loss if you default on your loan. You don't gain any kind of coverage or benefit from PMI as the buyer outside of the ability to make a down payment lower than 20%. But you don't have to pay the PMI forever or even for the duration of your mortgage loan. When does PMI go away? Well, you got to pay the PMI until you have 20% equity in your property. Equity refers to the percentage of your principal balance that you've paid off. It's not how much appreciation you had. You can contact your lender and request that they cancel your BPMI once you've built 20% equity in your home. Many lenders will automatically do this once you reach 22% equity. You must pay PMI for the duration of your loan if you have LPMI. The only way to cancel LPMI is to refinance your mortgage loan interest rate, and you have to worry about the interest rate, what's going to be, is higher, lower, or different type of loan. Bottom line on getting rid of PMI, it's a type of insurance that protects your lender if you default on your loan. PMI gives you no protection as the borrower, but it does allow you to get into your dream home with less than 20% down. As always, if you have any friends, family, or coworkers looking to buy, sell, or borrow on real estate, can we count on you to introduce us?